Good afternoon, everybody. Welcome to Q1 Tax with SAX. Pretty excited to introduce our two panelists today. Matt Giordano has been with the firm for around 10 years and recently was promoted as a partner. He is part of our tax controversy group. And Julio recently joined the firm and is in charge of the tax controversy group. My name is Shivani Jain, and I'm a partner here at SAX. So before I hand it over to them, they will be discussing some legislative updates, some IRS enforcement updates, hot topics of IRS exams, which I think everybody's interested in hearing. I'll go over some housekeeping items with respect to CPEs. And obviously a disclaimer that our firm provides the information in this webinar presentation for general guidance only, and it does not constitute the provision of legal advice, tax advice, accounting services, investment advice, or professional consulting of any kind. The information provided herein should not be used as a substitute for consultation with professional tax, accounting, or legal advisors. Before making any decisions or taking any decisions, you should consult a professional advisor who has been provided with all the pertinent facts relevant to your particular situation. For those of you who are looking for CPEs, make sure that you can stay connected to go to a webinar for the entire duration of the presentation. Partial credit is not available. Participants must answer 75% of the polling questions. If you have difficulty answering the polling question, hit the escape key to minimize your screen and try again. If that does not work, please type that into the chat box and we will help you out. The participants course evaluation in the handout section of the control panel should be downloaded, completed, and emailed to jtoshi@saxllp.com to receive CPE credit. The CPE certificate will be emailed to you within a few days, and we will be posting a copy of the PowerPoint presentation here along with the recording of the webinar as well in the next 24 to 48 hours. So with that, over to Julio and Matt.
Hello, everyone, and welcome. Thanks for joining us in our SAX Q1 here in 2024, where we'll be talking about enforcement updates, our government, and what's going on the Hill. As Shivani said, I'm Julio Jimenez, and I'm the partner in charge of the Tax Controversy Group. I recently joined SAX last September, and I've been here trying to get a feel for everyone at our firm, as well as all of you, our esteemed clients. Beforehand, I actually started my career at the Office of Chief Counsel for the Internal Revenue Service in Washington, D.C. I went there straight out of a law school. I am an attorney by trade. I was there working at both for the headquarters of Division Counsel for Large Business International. I also worked for the Associate Chief Counsel of International, and then I also worked at the front office for the Chief Counsel itself. And I had exposure to a vast array of issues. But the main function of what we did was review guidance to be published as regulations or revenue rulings. We also oversaw our position in litigation in the courts, and my office also had a role in advising the IRS agents running examinations on taxpayers. If any of you have seen Law and Order, the analogy is to the IRS agents being the police officers, and we in Chief Counsel were the prosecutors. But we tried to make sure that all three made sense and served the public. After being there for a while, I left and was at two of our big four accounting firms in their national office, usually working on both IRS controversy issues as well as international capital markets. Subsequently, I started my own firm, which grew and had to merge into somewhere, and so here I am with you all at SAX. I'm looking forward to working with most of you, and I'm glad to bring my expertise from not just the Internal Revenue Service and the wide breadth of our network through Washington, D.C., which we can now offer you, but we also want to be able to get involved with all of you, our esteemed clients, and anyone who's listening and participating, and getting to know your positions and getting to know your concerns and getting to know your business and your needs and anything that could be that involves you thriving economically. We want to be a part of that. We want to be your trusted advisor. And from complicated technical positions to figuring out just what to file, getting our insight and helping you determine what is the best things for you and how the IRS would react and how enforcement might be viewing certain things in this climate or in any other climate is our goal that we want to do in the department for you. Having said that, I'm also now going to pass it to one of our new partners and a longstanding controversy employee here at SAX, Matt Giordano.
Thanks, Julio. My name is Matthew Giordano. Like Shivani said, I've been at SAX for about 10 years now. Before SAX, I was at JP Morgan Chase & Co. in their corporate tax department, dealing with the large business and international division of the IRS's examination of their consolidated tax returns. And then I made the leap of faith from private accounting over to public accounting in 2014. I help clients out with various different types of examinations, federal examinations, state and local taxing authority examinations, like sales and use tax, help navigate them through the process, and we try to minimize the damage that's done on audits. And just by nature of being involved in that area, you see a lot of things, you come across a lot of things, and you help a lot of people out, and it's a very, very rewarding part of what I do here at SAX.
It's been great to be together because we get to expand and cover both federal, state issues, and as our footprint increases, not just in the Northeast, but the Atlantic Central and Washington, D.C., as we mentioned. Alexandra, can we have the next slide? So because we're giving this for CPE coverage, just wanted to outline for you guys our learning objectives and what we're trying to do in this presentation for you. We want to tell you what the government is up to, what the IRS has been doing lately, what talks that have been going on in the Hill, what are we looking at as a prognosis of upcoming law changes, and as well as talk a little bit about what's going on in the courts and give you a bit of a heads up of any litigation that's happened that I know some of you are keeping a keen eye on. We also want to let you know what's happening with a few specific points and cover with you some hot topics and discuss with you, what are some issues that the IRS lately has been really touching, such as the employee retention credit, what's going on in cryptocurrency, partnership audits, and a few items like that. So our goal is really to just give you a more concise exploratory presentation and give you updates on what's happening. Nothing too complicated. I promise we won't be hurting you with that. Can we have the next slide? So our agenda for today is going to have those four components. First of all, I'll talk to you a bit about what's going on in the Hill, our political climate and legislation that's being passed around, and getting a bit of a better picture of what it is that we're facing, because we are in a unique situation in the next 2 years that I don't think we've been facing in a while. Matthew will then talk to you a bit about IRS updates and what they have been doing, and we've also, I'll be helping present with him. And then Matthew and I will both be presenting for you some hot topics that the IRS has been putting there, and we'll be wrapping up the day talking about what's going on in litigation. As some of you may be aware of, there's a lot of penalty activity, and there's some big questions all the way in the Supreme Court. Can we get the next? So now we're going to have our first poll question. Again, for CPE credit, we're going to have these spread out throughout the presentation. These are the ever so serious question from our good folks at the firm, wanting to know who's got a deeper voice. Matt, I don't think we should be trying to sing any Italian opera at the moment.
No, we'll save that for after.
Maybe at some point we'll have a competition on Darth Vader impersonations.
Okay. Sign me up.
So pretty much a tie. Look at that. We have a next slide, please, Alexandra. Thanks. So legislative update. We have had a number of issues happening in Congress, and to get our heads around a bit of what is up there, the Senate has presented one thing called the Common Sense tax proposal. That has been put forward in mid-January, and we're not entirely sure where that's headed. If any of you have been keeping up with current events, the House is in no position to take anything new from the Senate at the moment. The House, however, which is what this slide is trying to talk to us a bit, did put forward their own attempt at a type of legislation to try to hit a few points. It's called the Tax Relief for American Families and Workers Act. It's not a big bill. It's exclusively a bill with some tax provisions. It's not something that we've seen before, like the TJCA of 2017 or any major overhaul. And yes, TWARFA is the acronym for it. It has been a bit of a mixed bag. There were three particular dynamics in the bill, and the Democrats have a little fun on their side. The Republicans have had a little Christmas wish on their side, and underneath all this is a bit of a poison pill. What do I mean by that? Well, the Democrats wanted some easing on the earned income credit, which the Senate Republicans did not want to give ground on. To kind of get there, Republicans got the extensions on the bonus, some net interest expense relief, and some expansion of the R&D credit, trying to roll back some postponing a number of other issues. The Democrats weren't happy about that. There are about 11 tax provisions in the bill, and they're looking to raise about $79 billion. And to pay for that, the tax revenue raiser from their end is the early termination of any employee retention credits, turning off the filing and no more provision for that. They estimate that'll save them $79 billion so that it's revenue neutral, which makes things easier to go through. There was some extension of the low-income housing credits, but none of the reforms that folks at the House and Ways and Means Committee were up and down about that. The poison pill that I had mentioned earlier is SALT, the raising of the SALT cap. The committee for this in Congress at the House of Representatives is really gung-ho and still gung-ho about wanting to either get rid of the cap entirely or raise it. They had a provision wanting to raise it by $10,000 for married couples. That did not make it in the bill, and so this started a little bit of infighting all around. There was a previous attempt to pass it. It failed, with all the Democrats voting against it and some Republicans joining the Democrats, so it wasn't able to go forward. All this kind of sets up what I call a duel for the future, with the TGCA having a number of provisions expiring in 2025, causing a massive amount of change. A lot of folks are trying to push that down to another year, hopefully after the election. That's going to create a massive showdown, and this bill is kind of representative of, hey, let's address some minor things and then put some stuff off so that we can then fight about that later on. Some things are not going to be welcomed by Senate Democrats, and we're not particularly sure where that's going to end up. If it does end up in the Senate, they're going to be a bit of back and forth of how that's going to go. If this passed the House, because they had 2/3 vote, they used the procedural rules to just get it through. Can we have the next slide? So some of the key provisions that are on this bill are the expansion of the child tax credit, bonus depreciation extensions, there's research and experiment expenditures and a few other credits, and there's a big provision to address the Taiwan situation. It's one of the few times where there's an actual provision statutorily to put in the Internal Revenue Code that would be giving treaty benefits, and it would be based on our model treaty that the US has, and it would be codified to identify Taiwan as a recipient of those treaties. And it was something that was pushed heavily into the House by various lobbying activities and our situation in the South China Sea should make that obvious. It also would bring around the end of the employee retention credits. So this was passed and sent to the Senate. As of February 16th, nothing has happened on the Senate floor. The Senate is currently in recess. They come back February 26th. They do have their hands full in the Senate. We have the situation in Ukraine, the situation in the Middle East, the border security situation with the Mexico front. The Senate has been tied up in mentioning what they are going to be dealing with. This is not really on many of their lips. Normally, before the Senate comes back into recess, they mention what's going to be on the floor. They indicate who is going to be leading it and on what committee will it be running through to then present on the floor. We don't have any of that information as of now. Because it is an election year and because the climate we're facing as time goes by becomes more and more unlikely that this would be paid attention to. If they wanted to pass this version of the House bill as is, they could push that quickly and procedurally and vote on it. If they would make changes of it, as a lot of people are expecting, such as that low-income housing reforms that the Democrats in the Senate want, a bigger expansion of the child income credit, there is going to be a bit of a showdown, and there would be changes which then would go back to the House, and who knows where that would go. If they adopt it as is, it would be a lot easier to just push through and not need to send it back to the Joint Committee or the Rules Committee. So we're not optimistic that this is going to pass. However, as we all know, this is all one big crystal ball gaze, and we don't know what the prophets or the spheres are going to tell us in the future. Can we have the next slide, please?
Julio,
Okay.
before you go into the IRS enforcement update, we do have a question here. What should we do if one of the provisions in the potential law change impacts us? Still file or move an extension?
So Matthew, do you want to answer that?
Sure. Yeah. I mean, I would advise on putting your return on extension so that you can, sit back, wait for things to blow over, and fully understand what your tax return should look like, rather than filing and then having to deal with amended returns. And a later section of this presentation will explain why, even more of a reason why you'd want to wait, depending on what type of partnership you are. So that would be my advice.
I think that's right. And here's I mean, I didn't want to particularly put it in a slide because I don't want to take more time than we have, but we're already in a unique climate for a number of reasons. Number one, our national debt is at 34 trillion and our deficit is running at about half a trillion, so 500 billion. These provisions from the TGCA in 2017, a number of them, a big number of them with significant impact, are set to expire in 2025. When those provisions expire in 2025, there's going to be a spike in revenue of about 700 billion. So that becomes a big number to be able to cover that deficit. When projected over time, it exponentially grows to about a trillion, trillion and a half, and almost hitting 7 trillion 6 years out. So this is a big deal for the Hill to try to figure out, wait a second, we have something that will happen organically without any inertia. It's going to expire and we're going to have access to those rules on the books. So there's going to be a lot of pushing to handle a lot of that exposure. What do we do when 199 Cap A expires? What do we do when our international regime no longer has certain benefits, losing the 50% deduction for FDII and GILTI income? The taxation of BEAT is going to go up. There's going to be a number of different rules. The corporate tax rate springs back up. There's going to be a lot of things that happen. Personal income tax brackets and deductions are going to go income brackets will go higher, deductions are going to go down. You can see a whole organic spider web of what's going to happen in 2025. So that's a big deal for the House. On top of that, you have an election year. On top of that, you have a split government between the House and the Senate, and makes it very difficult. So people are not particularly inclined to do any big decisions. If they do, even though certain drafts show that they're retroactive to the beginning of 2024, by the time they get there, that's going to be a point of contention. But if you do get something that eventually gets retroactive versus something that isn't, it's probably best to wait and hedge your bets. Having said all that, now let's talk a bit, let's get away from our Congress and move into the executive branch and talk a bit about what the IRS has been up to. Matt, go for it.
Thanks, Julio. All right. Yep. So this next section, we're going to talk about IRS enforcement, and not sure how many people are aware of this or how many people have seen this before, but we wanted to show everyone the organizational chart of the IRS, because really what we're talking about is a massive bureau of, as of right now, 90,000 employees. So it's very important that the IRS is organized in a efficient manner and operates as such. And if you look at the two columns running down the left side are really more internal type sectors of the IRS, and then the two columns to the right, that's the area that we as practitioners kind of live and breathe in for the most part. The wage and investment division, those are your wage earners and people who just have like wage and income. Then you have the large business and international division. That's the division of enforcement that handles your much larger taxpayers with assets over $10 million or very high income numbers. Then you have the small business and self-employed division. That's going to be most of like partnerships and S corps and the individual owners of those, but you do also see a lot of those taxpayers fall into the large business and international division. That large business and international division isn't just for large C corporations. If you have enough assets and you have enough income, flow-through entities and the owners of the flow-through entities will also be pulled into examinations under the large business and international division. And then if we move up to the top section, I do just want to point out the IRS Independent Office of Appeals. If you go through an examination and you don't agree with the results and you feel strongly about your position, but you don't necessarily want to go through the hassle and the costs of going to court, there is this Office of Appeals where you can try to resolve matters and try to get a better result than you're getting with the examining agent. And the Independent Office of Appeals has the ability to, what they refer to as, weigh the hazards of litigation, whereas examining agents do not. And what that means is they can take a look at a case and say, okay, well, if this went to court, there's a chance the taxpayer could win. So maybe let's try to come to a settlement and figure something out to stop it from going to that next level. And then up at the top right, I also want to give a little shout out to the National Taxpayer Advocate Office, because once the pandemic hit, the IRS was a disaster, and the National Taxpayer Advocate it's a program that you can reach out to if you're trying to resolve issues with the IRS, but you've done everything you can procedurally, but just shortfalls at the IRS, and that's resulting in some sort of financial burden to you, and you need to get this National Taxpayer Advocate involved to advocate on your behalf with the IRS. They can't tell the IRS what to do, but they can make sure that you're getting a fair crack and you're getting the proper procedures afforded to you as a taxpayer to resolve your issue. So they were very instrumental throughout 2021 and even 2022, helping our clients resolve issues that we just weren't able to resolve with the IRS because they were, to an extent, in shambles.
I think one of the reasons we wanted to share this with you folks is that we'll be talking about IRS hiring and budget in just a moment. And this is all that it will be supporting. And if you think of this as an arachnid with 3 legs on each side and 2 in the front, with the commissioner being the main body. And yes, we do know Commissioner Werfel and have a working relationship with him at the firm. You will notice on the left side, that's all internal. That's all a lot of red tape and supporting. It's the right side of the front, the bottom right, that you have, the business divisions, the enforcement bodies, and that's what most of us interact with. I mean, so just keep in mind that when we're talking about hiring and budgets, it's going to all of this, but it still will be impacting the enforcement.
Thanks, Julio. Next slide. Okay, so the section of this presentation was labeled IRS enforcement, but we also want to talk about the service aspect of the IRS, because that's a very big part of what the IRS does. Like, yeah, everyone thinks of IRS, they think about examinations and audits, but they do really try to help service taxpayers. And one of the things that they're doing, which is very unorthodox, I've never seen it in my career, is they have implemented Saturday hours on the key dates throughout tax season and even shortly thereafter. Again, like, to think about it, a typical federal government job, you're talking Monday through Friday, 9 to 5. So I think this is definitely the IRS's way of maybe trying to make up for how the last several years have gone, and trying to offer taxpayers more opportunity to meet with them. So they are opening up these Saturday hours on these specific dates. Looks like 9 a.m. to 4 p.m. February 24th, March 16th, April 13th, and May 18th. And it looks like even in Puerto Rico, they're going to have some offices open as well. And so for the February 24th date, looks like they're going to have more than 50 locations planned to open. And then for the March 16th date, it looked like more than 70 offices that they're going to be opening on Saturdays to try to help out taxpayers throughout their tax season.
So the takeaway is the IRS is aware that their customer service has been awful, and they're trying to do many things to catch up for. I think not just you folks as taxpayers, but us as advisors, we've had to wait days on the phone, and that's to an extent unacceptable for advisors. Not just is it charging for folks, but it's just when we have open issues that need urgent care, having to get up in the morning to get on and wait on hold all day, to not go anywhere, to wake up the next day to go back on hold. They're aware of it. And so they're trying to do several things that they have been advertising all in the last month. If you go to the IRS website, you'll see issues like this.
Next slide. All right, so hiring in 2023, they did open up more than 3,700 positions to expand enforcement on complex partnerships and large corps. And again, we're going to get into more detail on these partnership examinations and ways to avoid them if you're an eligible partnership. These compliance positions open in more than 250 locations nationwide, part of a larger effort to add fairness to the tax system. Again, this is kind of what we were talking about, where there's a lot of these high income earners and partnerships that in the past have had very low rates of examination, according to IRS statistics. And to try to bring fairness, they are allocating these resources and hiring in an effort to be able to examine more of these types of taxpayers that, to an extent, have been able to avoid examinations in the past for the most part.
So when they passed the Inflation Reduction Act last year, in 2022, they got a big budget allocation from that. And last year they added 3,700. Now, Matt, what are they doing this year?
So so that 3,700, I think that brought us to about 80,000 at the end of 2022. And
I think we have a poll question.
Oh,
all right, I thought that was going to be the next slide. Go ahead. Is our poll question? So I guess they're asking if there has been an expansion of the child tax credit, if that's actually happened yet. And so the answer is no, because the legislation has yet to be passed. It has left the House, but it hasn't been handled by the Senate yet. So can we do the next slide? So here's where 2024 is.
Yeah. So So we saw, so at the end of 2022, the IRS had around 80,000 employees. Then at the end of 2023, it was right about a 10,000 jump to 90,000. But then in 2024, this is where, remember, the IRS, they were allocated originally $80 billion over a 10-year period. Now 20 billion of that was taken away. But what they decided to do is that 20 billion that got taken away is only going to have an effect on the last 2 years. So years 1 through 8 are going to kind of run business as usual as if they had that 80 billion, but then the cutoff will have an effect on years 9 and 10. So I don't know if maybe they think that by the time that time comes around, there'll be some additional funding that's coming in.
Well, I think a lot of folks, because they've been buzzing this in the media, right? Again, in 2023, all they added was 3,700 jobs. For 2024, they're adding 20,000. And as they've been growing 10,000 each year, now they're planning to double that rate. And so then when I guess you guys heard in the news a bit ago, in one of these legislative passes to continue our budget, to be in a continuing resolution, because we haven't passed a budget yet, they took away some cash from the IRS. And folks were saying, as you may have heard in the news, oh, the IRS has lost cash, whatever, these enforcement things aren't going to happen. And the IRS has just bluntly responded and said, yes, they're going to happen. Our funding was over 10 years, and we're just going to take it out of the back years. So we're going to keep going with the allocation that we have for 2024, 2025, 2026, and the money that you took away from us will allocate to the last years. It's kind of their, nanny boo-boo to Congress saying you haven't really heard us. Anyway, next slide.
And a few other items we wanted to touch on. These the IRS is actually going to be setting up these temporary pop-ups in locations that are far from IRS service centers. Again, that's something I've never seen before. Another very unorthodox thing that the IRS is trying to do to enhance the customer service experience. They're also going to start trying to use AI pilot programs to handle calls coming in. Not sure how I feel about that. For me, whenever I call the IRS, it's always much better to get a human on the other side. But again, I think this is more for actual taxpayers calling the IRS. Hopefully not for us tax professionals who are calling the practitioner.
Well, I think part of the pilot program is also to smooth that out and try to use AI to pick up the concern and the question, and rather than the frustrating, dial a number, say what it is you want, oh, I'm not forwarding you, the AI can at least succinctly send in something to the manager with the issues that are being sought for. And secondly, I think the other thing the IRS wanted to do with it was analyze what the questions are so they know what issues to beef up or be able to get a report from, what are the concerns from the public. So theoretically, it sounds awesome. It just, again, comes down to practice. They can barely answer the phone. Where are they going to get people to beef up their technology?
Yep. This next bullet point was an interesting one. I attended a panel about this. Julio was kind enough to bring me down to DC Bar Tax Conference in early January, and it was a very interesting conversation. And basically, there's an argument out there. It's a constitutional argument about whether or not taxpayers should have to pay in order to pay their taxes, especially at like a very fundamental level with people like W-2s and just very basic tax information. And so what you're seeing is this. It's basically like another pilot program called Direct File, where the IRS is actually working with states to try to develop programs so that, again, very unsophisticated taxpayers with basic information can file federal and state for free. Again, very early stages on this. There's only a very small select handful of states that are currently working properly with the IRS on this, but it's something that they're taking seriously and looking to expand on in the future for sure. We already touched on the high net worth individual examinations. This is an area that the IRS is definitely taking focus on because they feel like these individuals have escaped examinations too much in the past. And then this next bullet point, this is another interesting thing that we're seeing. And I actually had a case come across my desk where it was a taxpayer that really shouldn't have been with the LB&I, Large Business and International Division. There was really nothing in the tax return that would have qualified it for that. But what's happening is LB&I and SBSC are working consolidated examinations in an effort to train more agents in how to perform LB&I examinations. So you're seeing some non-LB&I taxpayers getting pulled into LB&I examinations so that the agents that are experienced with LB&I can help train some of the SBSC agents, and maybe possibly vice versa. But that's the direction I've seen it in.
And we get to see a lot of that in the area of high net worth individuals and in the area of partnerships. So folks in real estate or investment or anything else that's partnership heavy, and those who are high net worth individuals, you know, you're going to be looked at through this consolidated lens that will probably most likely be anchored, like the partnership issue, out of LB&I now.
And it's not necessarily a bad thing, in my opinion, because when LB&I performs an examination, it tends to be much more focused. They know the areas that they want to look at, and they come in with much more direction versus the small business and self-employed, where they kind of come in and they just want to look at everything under the sun. It's just how the two different examining bodies perform the audit. So I actually don't think this is a bad thing, and I think it would be better for taxpayers and more efficient to go through more large business and international examinations. Other items of focus, you know, ERC, that's a hot thing. We have a whole section on that later on, and then conservation easements, and we're going to talk more about the small business and self-employed so-called dirty dozen, which I believe is on the next slide. All right, so yeah, as you can see, the dirty dozen isn't limited to a dozen. Sometimes it could be. It was actually a question I asked Julio. I said, Julio, they call it a dirty dozen. Does it have to be a dozen? He was like, no, it could be more, could be less. I think you said it started out at a dozen at one point.
I think it's just a term, and yeah, exactly. And I know a lot of firms use the term, or you'll hear SBSC dirty dozen. I don't know how many of you have had the bullets identified for you. Some of them go into subgroups, and they'll call that one bullet. But we just wanted to spell out for you so you guys could see and have as a reference what these are. By the way, all this that we're sharing with you is public information. You can get it either from the IRS's website or Treasury's website or different subcommittees, Ways and Means and Senate Finance Committee in the House and in the Senate. But in case folks hadn't seen it, this is the law of the land that SBSC has as a dirty dozen. And what does that mean? It means that that's what they're focused on. The IRS, just like any other organization, has front office folks with a vision, has managers, have people trying to implement that vision. And so these are the issues that agents get points for. They get to tell their managers, I found this issue, I get to work it. Managers get to tell their executives, we are enforcing and following our hot items that we care about. The employee retention credit has made it here, and a number of different technological scams, you know, using phishing in your email and smishing in text, people pretending to be advisors, people pretending to be the IRS. It has been unprecedented for them. So now there's a number of bullets in that dirty dozen that they look for.
Yeah, and the offer and compromise mills, I'll just mention that one because you probably hear a lot of advertisements on the radio or even see some on TV of people offering the IRS cents on the dollar or next to nothing to get out of their tax debt. There's these companies out there that just kind of mill these things out. The IRS doesn't really like that. And like there are situations where an offer and compromise could be a valid approach to handling tax debt, but these type of mills out there are not where you want to go for that type of an approach.
I think it's very focused. By the way, an offer and compromise is if you find yourself with tax debt and no resources to be able to pay it, you can tell the IRS, look, this is what I have, this is all I can look towards in the future. Why don't we call it a day, and this is what I'll pay you that makes sense. those rules are very narrow. You only get certain limitations. And there are folks who advertise out there saying, no, come in, we'll get your OIC, use a professional. And then what happens? Boom, it gets bounced because they just were granting things they couldn't do. And the IRS says, yeah, look, these are the narrow rules. And they turn to the taxpayer and say, sorry. And meanwhile, you probably paid them $10,000 to help them sort this out for you when they knew from the beginning it was never going to get sorted. But anyway, this is a sense of the different issues that SBSE has at the front of their head right now. What's interesting, if we go to the next slide, is that now these are getting a lot of issues in the LBI campaign. Matt, I'll let you do it. And so, as we can see here, sorry, go ahead.
Yeah, so what we did here, I mean, we're not going to read these all out, but we wanted to highlight the ones that can have impacts on individual taxpayers. So costs that facilitate a 355 transaction, distribution in excess of partners basis campaign. I could definitely talk a little bit about that. I think I want to stop and discuss that one a little bit here, because we're seeing this becoming a major issue on some examinations where if a taxpayer has a net operating loss that's carrying into an examination year, regardless of how far back that net operating loss goes to, the IRS has the ability to disallow that net operating loss if you're not able to substantiate basis back to the year that the losses are attributable to. So, we had a situation where there was basis going back to the pre-crash, the 0809 real estate market crash, and it was very difficult to get our hands on capital contribution information, recourse loan documentation. And unfortunately, in that situation, the IRS does have the ability to disallow the net operating loss. So that's where we've seen this partnership basis become more of an issue. So maybe not necessarily distributions in excess, but just the partnerships basis in general is a really hot topic that the IRS is examining heavily right now and looking to disallow NOLs coming into current years from prior years.
Just like SBSE has their dirty dozen, LBNI has a number of campaigns. And in the last month, LBNI announced these are our new campaigns. And as you'll see, they cover 3 slides. There's a lot more than what SBSE does. What we've highlighted in yellow for folks are things that could potentially impact either a partnership or individuals that normally might have been worked by SBSE as they get dragged into this new combination world. Items such as your 199, items such as 965 that your pass-through tax for individuals who had a foreign entity. A number of different issues, as you see, aren't really aimed at the Fortune 500 or large C corps, which might be part of the thought. It's expanding, and so we wanted folks to get, and can you do the next slide? We wanted folks to get an idea, not just spell out for you everything here that LBNI has said, this is our quote unquote dirty dozen, or they call them campaigns. These are all our projects. And these are everything that gets an LBI agent points with their management to show that they're working with them. And when they find these issues on exam, they get excited. Again, I think the takeaway here was the massive expansion of the LBNI campaigns and how much of them impact individuals or partnerships that they normally may not have had on their radar. Again, all this was released by the IRS a month ago in January. You want to go to the next slide? So now I figured we'd talk a bit in the hot topics of enforcement, and we've selected 3 for us to cover. But before we get started, let's do a poll question. So based on what we covered of the IRS hiring for 2024, what was the number that the IRS said they were planning to bolster their ranks with? I wish we could do the Jeopardy theme for folks.
Got to pay extra for
man,
that. Go to webinar.
I thought you were going to actually start singing it. I was like, that was not an invitation.
No, I'm saving my voice for the opera that we're going to do later.
So that's correct. The answer was 20,000. So 60% of us got it. 10,000 was what they normally grew at every year. And this year is what they're saying they want to double their hiring. So the employee retention credit. You know what we had mentioned in the statute that Congress was trying to pass, what the House had put forth for the Family Relief and Workers Act. There is a provision there in the statute that would say that after January 31st, 2024, no more ERC claims will be allowed. I kind of view that as a bit of a red herring because the IRS itself, from an administrative point of view, from an executive branch point of view, has said, we're not processing any more claims. We are putting this on hold and we are making it an enforcement focus. There was an announcement that came out last December, and there was another announcement that came out a month ago in January. They had indicated on several times at the American Bar Association, at AICPA gatherings, at different bar associations at the state level. I know at the New York State Bar they did. They have indicated several times that they're taking this personally. Now, this sounds good from a congressional point of view. This was a relief that was offered to the public. The IRS thinks that there are actors who have acted against that in bad faith and taken advantage of the system. And so it becomes political low-hanging fruit for enforcement agencies to say, we're going after so-and-so. They get to tell Congress, look what we're doing. People up for re-election get to look good. And taxpayers, meanwhile, get run through the mill. What they have, bigger than anything, I think it's the main thing to put forward that is brand new, and Matt and I are still learning the ins and outs. We have a voluntary disclosure program. If you guys remember those initials from beforehand, they've been used in various events. One time was for people who had offshore filing. Another time there was a global settlement initiative for people who partook in tax shelters and listed transactions. And it's an invitation for the IRS to say, come now, we'll be somewhat lenient with you, we'll resolve this. And if not, if we have to actually go out and find you, it's going to get worse for you. So you mind turning the slide? So this was the actual blurb that came out in December 6, 2023, saying we're going to be sending out letters, and we've sent more than 20,000 letters already saying we're not allowing your claim. We think there's something off here. Either you don't exist or you didn't have employees in this time period, and this doesn't make any sense. The IRS is continuing to look at all this and has set up the voluntary disclosure program because after they've done their internal review and after they've sent out over 20,000 letters to people saying, I'm denying your claim, now they're thinking, hey, this is probably in an order of magnitude larger than we thought. So why don't we tell the public, come and get it while it's hot, come and reconcile and confess your sins, or else we're coming after you. So the next slide will start putting out for us what the IRS was thinking and why they wanted to set up this voluntary disclosure program. They have thought that they've got, and I think in the actual release, they were thinking of more than 300,000 taxpayers, 300,000 claims that they found inappropriate, and they've only mailed out about 20,000 letters. So that's big enough for them to say, we need to do something. Can we have the next slide, please? So we now have IRS beefing up the review of employee retention credits. They have a whole strike force that they've put together. And they've also mentioned to folks, you know, if even before you want to do a voluntary disclosure, if you wish to withdraw your claim, you certainly can. And on their website, they've put up procedures on how to go about withdrawing that claim. Can we get the next slide, please? So the voluntary disclosure program is going to be open through next month. After March 22nd, it closes. The big carrot is that you're going to get a 20% cut. They're expecting you to pay back what you took minus 20%. So that's the carrot that they're looking for. The IRS may have questions, and then they'll give you a formal signing agreement that would prevent any future examination. So 20% you get to keep is the carrot that they're offering for people to come in. Obviously, the IRS is backlogged. It's trying to hire folks this year to try to handle with its workload. And of those 20,000, some are destined to go to enforcement, if not the lion's share. The IRS website has set up a form for you to submit to how to go about getting this. And, you know, we beseech you that if you're going to try this, to please contact myself or Matthew so we can give you the best way to guide through it. The IRS is upset about it. There's not going to be much sympathy that we expect, even though certain cases are difficult to discern. When the IRS gets to this stage, as they did with listed transaction and other reportable transactions and other, you know, identified issues, the compassion meter goes down after the voluntary disclosure program. And that might very well mean calling the criminal investigation unit. So let's get the next slide. So we have now another poll question. Which is not part of the SBSE Dirty Dozen? I think this one might be a tough one. So I'm not, you know, I'm leniently looking at however people try to answer. There's one that is a better answer than the others, but I can see how folks might get distraught with this one. So that's right. The better answer is fake phone numbers. Although I could have seen people who got confused if they wanted to think, you know, well, does that mean scamming? Is that somehow from the schmissing? But fake charities, monetized installment sales, and CRAT are all identified in the SBSE Dirty Dozen. Next slide, please. So this is a bit of a summary of who gets to come into the ERC voluntary the voluntary disclosure program. And as you see, it's a bit common sense. As long as you meet a number of the elements, you can come in and apply. If you're not under criminal investigation, if you're not under an employment tax investigation, if you realize that what you owe is zero, and if you've already been paid and you realize you shouldn't be paid, if you used a third-party assistant, you can't apply for yourself. Contact your third-party payer to apply. It's a pretty common sense approach to how voluntary disclosure programs work. There's nothing here of rocket science. Again, this is all publicly available information. Next slide, please. So there's a form that you fill out to get the disclosure, the 15434, and you're going to have a couple of additions that you're going to add for it. There's the SS10 that if you're doing for 2020, if you had an authorized person that you want to use, if you aren't able to pay back the 80% of what you took, you can enter into an installment agreement. You don't have to pay it all up front. I know that's a popular question for folks. Again, it's kind of vanilla and common sense. The next slide, please. So how does this all end? Well, if you go in and you send in your application and you pay your money and you do your mea culpa, the IRS sends you a closing agreement. You need to sign it. Anyone who is requiring it, you send it back in. And that's the end of story. There's no appeal after this, but the IRS also will not examine you in the future or take any further action. That shuts them up. Again, all this is available on the IRS website, and we're happy to walk you through it. Next slide, please. So now we're going to talk a bit about with Matthew on partnership audits, because I know, especially for our folks in real estate, it is the most preferred way for small and medium-sized businesses to organize themselves for tax purposes and not have dual layer tax. And it's an open issue across all industries and everyone in the world, from large investment partnerships to small real estate or business owners.
Thanks, Julio. Before I move on to this section, I was thinking maybe it'd be a good idea to talk about some of my experiences with the ERC examinations that we've had.
Oh, sure. It would be welcome. I think that'd be a great thing for folks to hear about.
Okay, great. Yeah. So we've had a few. In the past, they were coming in as standalone examinations, and what I mean by that is someone from the IRS was reaching out, and they were specifically looking at the ERC. They were specifically examining the ERC claim. They were looking into eligibility. How did you determine you were eligible? Was it based on the gross receipts test? Was it based on the disruptions test? That's your first hurdle that you have to get through when dealing with the ERC examination. Then you get to the calculation, making sure the calculation was performed properly, that certain like owner employees and fan relatives are being pulled out of the calculations and things like that. Now, then there was that moratorium where they stopped processing the claims. And I think what happened during that moratorium is agents were trained on, like, more than just the payroll examiners that were already out there doing these ERC examinations. Other revenue agents were trained as well, because now what we're starting to see on some existing examinations that were isolated to income taxes, those same revenue agents are now opening up the employee retention credit for examination and examining them as well, asking the same type of questions that the ERC examiners were previously asking. But now it's and the third hurdle, sorry, there was a third component to the ERC exams is, did you reduce your salary and wage expense on the income tax return related to the period that you filed the ERC claim? So those are the three hurdles. But so it's the same three things that they're looking at. But now we're just seeing it as part of other examinations. So I did just want to give people a heads up on that they're not just standalone ERC examinations anymore. They can be conducted through other forms of examination as well.
Kind of the point system that we talked about, they're looking for this, and it doesn't have to be a particular isolated vehicle. Whatever they're examining you on, if ERC is somewhere on the table, they smell it, they're going to incorporate it, look at it, and just work it through common sense examination.
That's right. Okay, so now we're going to move on to the Bipartisan Budget Act, the BBA examination. We're going to talk about, this conversation is going to be focused around partnerships specifically. So that's 1065 filers, so partnerships and limited and LLCs that are filing partnership returns. And there were, prior to this BBA, which was passed in 2015 and it took effect in 2018, the regime that partnerships were examined under was called the TEFRA. It's the Tax Equity Fiscal Responsibility Act of, I believe, 1982. So we're talking before I was even born was when this came into play. And the reason that TEFRA came in is because prior to TEFRA, there was actually the IRS didn't have the ability to examine a partnership itself. What they would have to do is examine each individual partner of the partnership separately. And it was just becoming mayhem. You were getting different results for different partners. So they implemented TEFRA as a means to be able to examine a partnership at the entity level and then flow through the adjustments to all of the owners.
It's a seesaw. Sorry, it's a seesaw of the partnership regime. A partnership itself doesn't pay tax. The partners do, but the partnership usually has the goods and the books. So when the IRS examines, they don't know which way to go. You know, a partnership doesn't owe money. The partners do, but the partnership is where things are at. So it used to be that whenever they looked at a partnership, let's look at everybody. TEFRA was the first attempt at trying to alleviate that seesaw, and it was a headache for many people, to which then the BBA is now trying to do another regime in trying to solve that issue. But there'll never be a nice answer. Go ahead, Matt. Just wanted to get you back.
No, thanks, Julio. Yeah, so what happened as years went on and partnership structures would become very complicated and various tiers, like levels and levels of tiering and ownership, it became extremely burdensome for the IRS to pass these adjustments out to the partnership partners, all the individual partners. And so what they decided to do with the Bipartisan Budget Act of 2015 is completely overhaul the partnership examination process. And long story short, we'll get into a little more specifics later, is now, yes, the partnership is still examined. That hasn't changed. But now when you get to the end of the examination, we see drastically different processes and procedures that need to be followed depending on which way you want to go, because the default, and we'll get into it, is that if there's, let's just assume an increase in income, which would result in what's referred to as an imputed underpayment at the entity level, the partnership is on the hook to make that payment.
Whereas they can punch the partnership. That's the
exactly.
big new theory. They can punch the partnership, and if you've moved on, if there are new partners, if money has been spent already, it becomes a headache.
Now, there's ways around it and ways out of it, but it's very complicated procedures that you have to deal with. So as far as this side goes, I'm just going to focus on that right column under the BBA. So now what used to be referred to as the tax matters partner is the partnership representative. And one of the things I want to kind of hit home here is that the partnership representative doesn't necessarily have to be a partner of the partnership or a member of the LLC. And the reason that they did this is because if you have a partnership that has all foreign owners, let's say, you're actually required to have a partnership representative that has some sort of U.S. presence, so that if the IRS needs to reach someone and get in touch with someone and find someone, that they don't have to jump on a plane to do so, and that there's somebody domestic in the U.S. for them to reach out to. And I guess it also offers the partnership the ability to appoint a third party as a partnership representative, so that there's maybe somebody who's completely impartial, because the partnership representative, whoever's assigned as that partnership representative, has complete powers to bind the partnership at the end of an examination. They don't need the approval of the other partners, regardless of what now the operating agreement or the partnership agreement might say otherwise. But as far as the IRS is concerned, this partnership representative has sole authority to act on behalf of the partnership. So it's very significant change that we see here. And then there's just some procedural changes that we don't really need to get into specifically on this slide. Just different names for forms and notices that they're issuing through different steps of the examination. But we don't.
And I think a key thing in all that is to remember, since the partnership is getting punched, the partnership gets notified, and then that kind of can seal the deal for the partners. You know, it's important to keep in mind what you're going to be facing and to decide how you want to handle this. And I think Matt's about to talk a little more about that.
Yeah, definitely. Next slide. Okay, so first I'm gonna discuss staying in the centralized partnership audit regime, because this is actually the default. Every partnership is subject to the centralized partnership audit regime unless an eligible partnership elects out on a timely filed return. You know, we often hear people use the frame like, oh, electing into CPAR. It's not really correct, because every partnership is in it. You have to elect out of it if you're eligible and you wish to do so. Some very important things that we want to know about staying in CPAR is you can no longer file an amended return. That terminology just doesn't exist anymore. If you discover a change for that partnership return, you now have to file an administrative adjustment request. I'm telling you right now, these are time consuming, they're complicated, and they can have harsh results if the adjustment results in a decrease in tax for the owners.
And remember, Matt, it kind of flows from this new philosophical change. If the IRS is thinking I can punch the partnership now, and by the way, it's all statutory, then yeah, I don't want you amending returns. You ask us for permission on whether or not you can change the partnership position.
Yeah, that's a good way to look at it. Yeah, definitely. And I kind of touched on this on the last slide. If the IRS examines the C-PAR partnership, it's much more complicated and lengthier procedures. And there's also an extreme backlog right now. Even after you're done with a C-PAR, with a BBA examination, there's, I believe, an 18-month backlog with the technical services group to figure out how all these changes are going to be reported in the final notice that you receive. So it's if we'll get into getting out of it later on. But we just want to really stress how much more complicated and lengthier these procedures are, and how much longer the C-PAR examinations can drag on for taxpayers. Now, one of the benefits, but we'll kind of get into a reason why it's not as much of a benefit as we may have thought in the past. The IRS does not automatically open the individual owner's tax returns for exam. So in the past, partnership exam was open by default. The individual owners were also open for examination as well, because if there were any adjustments, they were going to have to flow through to the individuals. So it was just a part of the procedures for the individuals' tax returns to be opened in conjunction with the partnership examination. With the C-PAR, that doesn't automatically happen. So this was a key feature that in the past kind of deterred people from electing out. They were like, no, we kind of like the idea of an examination just staying at the entity level and not necessarily having to worry about our individual returns for being open. But what we've seen in audit activity over the past several years is that the IRS is still opening up individual owners' returns. And because of that issue that I mentioned earlier, I believe that was on the LB&I campaign about partners basis. So they still want to make sure that the individual owners that are partners in these partnerships have basis to report the losses or take the distributions that they're taking, and to examine material participation in the audited partnership. And those are items that can only be examined at the individual level. They can't really examine that at the entity level. So really what we're seeing is that even though the individual returns don't automatically get open for exam, they are anyway, because the IRS wants to look into these other issues that come in tandem with partnership examinations. So that feature is really no longer as appealing as it once was. And we already touched on this, that at the end of an exam, the default is that the partnership is responsible for an imputed underpayment. That imputed underpayment is it's calculated at the highest applicable tax rate. Now, again, there are modifications that you can apply against to work down that imputed underpayment. If you have, for example, like a C corp partner that's tax rate's 21%, they'll drop that. There's some other things as well, and there are also push out elections available, but these push out elections are very cumbersome. They're burdensome to go, because basically what the IRS is saying now is like, all right, you want all these adjustments to pass through the owners. That's fine. Now you do it. We're not doing it anymore. And that's where the push out election can be key. And you can see some very significant savings tax wise, but the burden and the fees to complete all of the necessary forms that are required and to recalculate all the prior year tax returns, those costs can add up pretty quickly.
I mean, the philosophy stays through, right? Again, the IRS can punch the partnership. So this was the big carrot of this regime. We go in, we look at the partnership, we get what we need, end of story. I don't need to look at partners. Partners can go off and live their lives. It's just easier said than done, as we're all learning, because what happens? A lot of these issues happened before partners were involved, and now new partners are sitting there. The partnership may not have the assets or the ability to pay. It might work well with a large partnership, doesn't particularly translate into an easy, nice carrot. And especially in real estate and other businesses where a lot of investors, a lot of the partners, they just want to be left alone, and say, hey, sort this out internally and go. it's not as nice of a sounding net in our experience. Again, it's something to be decided on a case-by-case basis, but this kind of led into say, well, if you stay in CPAR, this is what you're getting.
Yeah, and all of the revenue agents that I've worked with are not happy with this change either. It's created more burden for the examiners, less on the technical services group that used to have to do all these calculations in the background. But for the examiners that we're working with, they hate it too.
No one's ever going to be happy in these situations, but this was one where it does seem that it made a bit turn for the worse, and agents now have to rally up. It's why, when we were talking earlier of the IRS points, that's why LBNI has kind of stepped in and bear hugged all of this, and they've named a champion for partnership audits because it can get a bit messy, and they needed some way to form, check, and evaluate what's working and isn't working.
Yep. Okay, next slide. Okay, so now talk about electing out of CPAR if you're eligible. So now the partnership will be in a position where if they discover a change later on at some point, you can amend the return. And it's kind of business as usual. You amend the partnership return, you issue amended K1s to the partners, and the partners amend their individual returns. Everyone moves on with life. Not really that complicated, as opposed to the administrative adjustment request, which can create some severe complexities. In the event the partnership is audited, examination procedures are much simpler. You don't have all these different extra steps at the end where you have a modification phase and a push out phase. The partnership's examined, they calculate the changes, and then they flow those adjustments through to the individual owners. Everyone walks away. So again, much more simple. And the one thing we do want to note here, this is very important, because this is kind of why we're advocate for electing out if you're eligible, because at the beginning of a partnership examination, there is a 30-day window to revoke the election out of CPAR if the partnership wishes to undergo the examination through CPAR. So with that option at the beginning of the partnership examination, there's really no reason to stay in anymore if you're eligible to elect out. So we did want to throw that little tidbit out there for everybody as well. Okay, next slide. All right, so we're talking about staying in versus electing out. Well, now we're going to talk about who's actually eligible to elect out. So if you have partnerships with 100 or fewer eligible partners, and these partners include individuals, C corps, foreign entities that would be treated as a C corp, S corporations, and estates of deceased partners. I do want to jump back up to that S corp bullet point, because for purposes of this 100 threshold, you do have to count the shareholders of the S corporation. Okay, so keep that in mind. Because if you might be at 95, but then if your S corp has 10 shareholders, you've blown that threshold, and now you're no longer eligible to elect out. All right, so that's who's eligible. So now, which partnerships are not eligible to elect out? Partnerships with more than 100 partners and/or ineligible partners. So ineligible partners include other partnerships. Again, the whole purpose of this was the issues with the tiering and the complex partnership structures that were getting more and more popular. So partners, if you have a partnership partner, you're out. Trusts, foreign entities that would not be treated as a C corp, disregarded entities. That's even like a single member LLC. So if you own an interest in a partnership through a single member LLC, that partnership is no longer eligible to elect out. You're actually stuck in the centralized partnership audit regime. Estates of individuals other than deceased partners, and then people who hold an interest in the partnership on behalf of another person. I haven't seen that one, but that's one of the listed ineligible partners.
So the magic number is 100. 100 true partners is the cutoff.
All right, next slide. All right, I think we're back to you, Julio.
Wanted to talk just a little bit in the last 15 minutes that we have. Wanted to mention a bit of digital assets and where that is standing, and then cover through some litigation updates on a very high level. A lot of folks have been asking, where is the digital asset world? what's happening. And think of it as having two fronts. One of them is the substantive front. How are digital assets taxed? What character do they have? When are they taxable? Who pays the tax on them? And think of the other side as a compliance side, reporting. Who has to report digital transactions? Both of these are being considered by the Department of Treasury. The Inflation Reduction Act gave us actual statutory language for the reporting of digital assets aimed at the similar idea of our 1099 reporting. Brokers, dealers, people in certain knowledge positions are the ones who have to 1099 out reporting, 1099 out digital currency, digital asset transactions, and they're coming up with a 1099-DA for this reporting. Those regulations have been proposed. Those regulations have a lot of quirks in addressing who is a broker or a custodian that is responsible for filing these 1099-DAs. We have large houses trying to figure out what their needs are, and we have small houses trying to figure out how do they comply, how do they get a hold of this information. Those regulations are not final yet, and because they're not final yet, there were a lot of questions from the public on when and how do we need to report. Lo and behold, this is still a few years out. You know, transactions in 2025 will have to be reported in 2026. It was effective earlier, but the IRS and Treasury have had to keep pushing it and trying to address these complicated questions. One of the prongs of reporting was the $10,000 threshold for your Form 8300. Can we get the next slide, please? Sorry, let me go back to the other one just a moment. I wanted to let folks know that that had been something that was addressed by the IRS in the last month, trying to put that on pause. There's a new Form 8300, and that addresses supposedly a space for digital transactions. That is still on pause for the moment. The other half of this universe, the substantive rules, how are digital currencies transacted and how are they taxed? We are still expecting regulations any minute, and the word from Treasury is that they're going to kind of follow each other. As soon as they finalize the reporting, then we'll get the substantive. Next slide, please. So our poll number 5. What does VDP stand for? This one should be, I think, low-hanging fruit for us. So that's right, voluntary disclosure program. Next slide, please. So now we're going to run through just a couple of cases of what's been happening in the courts. And as everyone wants to know, first and foremost, what's going on in the Supreme Court. And there we have a big question that you guys may have heard of in the news, and that is the Moore case. Moore is addressing the transition tax of Section 965 from the TGCA. Before the TGCA, if you had a foreign entity and it was pregnant with earnings, unless it was of a particular type of income, you didn't pay tax on it until you brought it home. It was the deferral. It was one of the carrots for promoting offshore investment. The TGCA went ahead and put a transition tax saying whatever your controlled foreign corporation is pregnant with is now taxable. And so you have to pay up for that, ending that deferral universe. even though at a lower tax rate. But there is a party taking this to court, and it is going all the way to the Supreme Court, indicating that just because an entity is pregnant with earnings doesn't mean you have a right to tax it, that it needs some kind of realization event. If not, you're not under the income tax rules, and thus you need to follow the old constitutional rule. A lot of eyes are on it. It might be something that makes concrete whether you need a realization event, whether you need an actual cash event for taxation. Unfortunately, like all other Supreme Court decisions that we've had, there's probably an easy out that the Supreme Court will take, and that is there's already been a realization. That foreign company has already made its money and brought it in, and so end of story, you owe tax on it. There might be a couple other more sophisticated theories, but that's the general idea. A lot of people have eyes on it because they're waiting to see if the Supreme Court actually articulates when you have to be taxed in light of a realization event or a recognition event. And there is another similar case that is trying to be, that is currently in stay, looking under it in Section 958. Can we get the next slide, please? Matt always asks me, well, what about this Loper case, Julio? Why are you even talking about this? It's a phishing case. Loper is a phishing case, but at stake in this case in the Supreme Court is the validity and use of a regulation. The IRS, Department of Treasury, is the largest body by far of issuing regulations. If you were to look at our Internal Revenue Code, that might be a volume or two. Our regulations can stand 7 or 8 volumes. They're ad infinitum. So it's important what kind of authority those regulations have. There was an old case in Chevron, was the name of the case, that said when it comes to regulation, if there isn't a statute on point and the regulator is reasonable, that regulation gets the deference of a statute. So it's as if the IRS is making law when it issues regulations if they met those 2 points. In this phishing case, unrelated to that, they are arguing that standard, that test, and trying to put forward and say, hey, wait a second, unless there's some ambiguity of what's going on here, if the taxpayer comes up with something reasonable, that should have just as much strength. And other, I'm generalizing on the theories, but that's an imprecise description. So we like keeping an eye on that as well, because that could severely impact a number of IRS regulations and the way that the authority that we use for them, how agents can use them, and how we as advisors rely on them, and how you as taxpayers are resulting on them. So these are 2 cases in the Supreme Court with omega level decisions that may impact big time what we view as our landscape of authority. Next slide. So here we talk a bit about a number of penalties, and I wanted to mention a couple of the FBAR updates, and I give here, we won't run through all of them, but we do have here a number of cases that it's not going so well for the IRS and others that are. In particular, the Burga case. And the big takeaway here is that you get to go per form. There were 100 and something, what was it, 62 accounts that weren't included in the FBAR. And so whether or not there was something willful hounding here, they were hit with 120 million. And upon challenging this into the courts, the court found that there was there wasn't any factual issue here. It was just a matter of whether or not they had authority, and that's being looked at. So in the case of a couple using Liechtenstein vehicles, that's up for, we're all keeping an eye on it to see if we have an articulated rule of authority. Next slide, please. Arosta is one other one that is using for when are you an actual resident and having to file. And we're keeping an eye on this one because the plain language of the regulations for FBAR are pretty clear, and the government is kind of pushing that this person didn't use their treaty tiebreaker position in the filing to say that they are not a U.S. resident, but rather a resident of another country. The decision that may come in on this might be a big deal for in order to claim treaty benefits and your dual residency status in a tiebreaker to see if you have to file an FBAR or not. Next slide. Bittner was another victory for taxpayer momentarily. That's also going to be going to the Supreme Court. And this is, you guys may have heard this one in the news, on the account versus form. And the IRS had preceded that various forms had to be used to disclose different accounts, not that you're penalized for one form. And so the penalties ran by account, totaling $2.72 million in penalties. And a taxpayer is saying, no, you should have penalized me by form, bringing it down to $10,000 a year with a $50,000 cap. That's now being sent to the Supreme Court. Next slide. Conservation easements are another one that is being held into the courts. The IRS has been over the top in cracking down on this and litigating. It's not a transaction they like. They identified it as a listed transaction and a transaction of interest, and they've had some problems in the courts. The tax court, here we list for you, 3 positions that hurt the IRS. And the IRS is still looking to appeal all 3 and also has over 30 docketed cases on the issue. Next slide. This was another one that folks have heard in the news, and those are the penalties arising under Section 6038 for a Form 5471. And this one gets a little esoteric because the penalty that was assessed under 5471 by the IRS is being challenged by the taxpayer, saying the IRS doesn't have an authority to penalize it under the statutory structure of the Internal Revenue Code. And some folks say to themselves, well, how can that be? How can the Internal Revenue Code prescribe a penalty, but then the IRS not be able to assess it? And the answer is, well, there are a couple of code sections that interplay on what the IRS can assess, meaning as an administrative matter, after examining you, can send you an assessment, a piece of paper that says you owe this penalty. If not, the IRS would have to sue you in court. And so they wouldn't be able to send you a piece of paper that says you owe this penalty. They would have to litigate against you and take you to tax court or district court and say you forgot to file this, and so you owe a penalty. For the moment, it was a victory for the taxpayer, and that's being appealed to the Washington, D.C. Circuit. And the court found, hey, IRS, we don't think that this is framed in a way that you can assess it. You have to go and file it yourself. And I think that brings us up. I don't know if we have another case. Nope, we have our final poll question. So, what is the new form on digital assets? By the way, as we wrap up our time, I wanted to thank you all for attending. Any questions that you may have, particularly on any of the issues that we raised, please don't hesitate to contact us at SAX. We are here, and like we said at the beginning, we're looking forward to supporting you as our trusted advisor and want to learn everything we can about you to make sure the right decisions are made for you and your financial future.
have some questions in the queue, but we have ran out of time. So, we will get back to those individuals. And most of the questions relate to ERC. So, uh, Julio or Matt will be reaching out to you separately to just respond to your questions.
And that is correct, 10I-98. So anyway, thanks for your time. And we are here at the 90-minute mark. And thank you for sharing with us and looking forward to working with all of you.
Absolutely. Thank you, everyone.